Just look at the level of margin debt. I mean, the level of margin debt is over 1.1 trillion, having risen over the last 10 years from about 300 billion. And that is financing stock positions. We can guess roughly 3 times that. So when this bubble pops, the banks will be foreclosing as quickly as they can, which of course will drive the market down even more rapidly. And the interesting thing is watching Bitcoin, because Bitcoin basically is a tech stock with no assets, no earnings, but just the vibes, if you like. And you can see that it correlates so closely with the Magnificent Seven.
Financial markets are under immense strain, fueled by a surge in margin debt that has risen from roughly $300 billion to over $1.1 trillion in the past decade. This leverage has financed stock positions at roughly 3 times that amount, inflating equity valuations and creating a fragile environment where even a minor shock could trigger rapid bank foreclosures and sharply declining markets. According to Alasdair Macleod, the artificial support propping up equities has masked the underlying risks, making the system highly vulnerable to a sudden correction. Bitcoin, often treated as a speculative tech asset with no underlying earnings, has closely mirrored the movements of the Magnificent Seven. But Danny asks, can this correlation survive when the credit bubble bursts? The speculative behavior in both traditional and digital markets signals the peak of the cycle, warning investors that risk exposure is at historic highs. The looming collapse underscores the importance of moving out of credit-dependent positions and seeking assets with intrinsic value. Tangible assets like gold, free from counterparty risk, may offer protection against systemic vulnerabilities. Jamie Dimon has also highlighted that with liquidity strains intensifying, the next financial reset could arrive sooner than many expect, reshaping wealth, markets, and currency stability worldwide. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
We had QT, which was also tightening the system, and this is why the Fed has stopped doing QT and will reintroduce from this month, next month, whenever, quantitative easing. But that again is printing money. So we're on a printing credit roundabout now. How else can we print it? Well, let's find another way of doing it. That's where they are, and this is roughly where Germany was, I think, in the very early 20s, 21, early 22. And we know what then happened. We can see how it's going to happen here too, because when the credit bubble bursts, and the credit bubble will burst, this is the biggest credit bubble in history. And on top of that, it's looking so much like 1929 with Trump's tariffs on top, replicating Smoot-Hawley and all the rest of it. When it bursts, what it's going to mean is that the Fed and the Treasury will stand by to rescue the entire banking system and also all the major zombie corporations in the U.S. economy. They have to do it because of the unemployment mandate, if you like. But of course, the Fed is also seeing in its beige book signs that the economy is falling over, toppling, if you like, stagnating, however you like to put it, turning down. So this is a time of maximum risk. Now, at the moment, I don't think that the stock market really realizes this, but there will come a point when it does. But for now, I think with extra QE coming in, the tightness in credit markets being alleviated, it could well feed into yet higher equities. In the very short term, because what this credit has been doing is it's just been puffing up equity markets. It's been angled at financial markets. Just look at the level of margin debt. I mean, the level of margin debt is over 1.1 trillion, having risen over the last 10 years from about 300 billion. And that is financing stock positions. We can guess roughly 3 times that. So when this bubble pops, the banks will be foreclosing as quickly as they can, which of course will drive the market down even more rapidly. And the interesting thing is watching Bitcoin, because Bitcoin basically is a tech stock with no assets, no earnings, but just the vibes, if you like. See that it correlates so closely with the Magnificent Seven. Magnificent Seven go up, it goes up. Magnificent Seven goes down, it goes down. So what's it doing now? I mean, Bitcoin basically is threatening to break out on the downside. It's dipped below its 250-day moving average, and I suspect that if it breaks that $100,000 level, you will see an avalanche of selling. There are an awful lot of people long of Bitcoin who are just in there for profits. I mean, we get from the sailors of this world this sort of wonderful stuff about how it's going to go to the moon and so on and so forth. But, people are in it not because they think it's the new go. I mean, that's for the fairies. They're in it basically because they want to make money, and they think it's an easy way of making money. You get this at the top of every credit bubble. And what the whole of the crypto market is telling us is just that. We are at the top of the bubble. I don't know how much leverage there is, but this is a global problem. Things are going to turn sour. Now, it's always impossible to pick the exact top in a credit bubble, and you can be wrong for 10, 15, 20% easily, even though you've analyzed it correctly. So I think I'm not prepared to say that we are actually at the top and all the rest of it, but I'm seeing a few things breaking down. And we know we've got the liquidity crunch, and we know that what the Fed is in effect doing is moving from targeting inflation to supporting the economy and ensuring that it's got enough liquidity. That is bound to undermine the purchasing power of the dollar. So, okay, it's 100, but also at the same time, I mean, this is the king rat of currencies. Other currencies are in exactly the same boat. It's just a question of who goes down fastest. And at the moment, it's not quite the dollar. The dollar might win that race to the bottom shortly afterwards. I don't know. Mm-hmm. Do I care? No, I don't care. But the thing that's interesting is that these, with the system under strain, I guess this is why people like Jamie Dimon are saying gold's going higher. And why, Morgan Stanley sort of turn around and say you should, put 20% of your portfolio into gold. Now, that's an extreme statement. A very extreme statement. But I think that the really senior bankers see these dangers. They must be concerned about it. And I think that they would have told the Fed, look, you can't go on tightening like this. We're losing deposits which are going into the general account, and we're not seeing it come out the other side. We are under strain. You carry on this way, you're going to see the same sort of thing we had in September 2019. You may remember when the repo rate suddenly shot up to about 9%. And the Fed had to come in and sort it out. But we're not far from that sort of thing happening. I mean, it is tight, very, very tight. But where does this take us? Well, the thing that's absolutely clear is that if we can look through the top of the credit bubble, when it starts going down, Danny, you will see inevitably the duty, if you like, of the Fed and the US government basically is to keep the show on the road. And how do they do it? They would just accelerate the printing presses. What did they do in Germany in 1922? Accelerated the printing presses. We have exactly the same situation. And on top of that, we can superimpose our lessons from 1929 to 1932. The difference is that in those days, businesses went bust because the dollar was on a gold standard. And the only way in which credit got wiped out was by debtors going bankrupt. And the debtors included something like 10,000 banks.
Alasdair Macleod highlights that the Federal Reserve's halt of quantitative tightening and the reintroduction of quantitative easing indicate a decisive policy shift from inflation control to maintaining liquidity. He notes that this renewed money printing mirrors Germany's early 1920s credit excess, where continuous expansion ultimately led to currency collapse. As the Fed and Treasury prepare to support major banks and corporations, Macleod warns this short-term stabilization could severely weaken the US dollar's purchasing power and global credibility. Macleod further cautions that record-high margin debt and speculative trading reflect the peak of a historic credit bubble. With liquidity tightening, forced asset sales may trigger a rapid market decline. He predicts that, in response, the Fed will escalate monetary creation, potentially replicating Weimar Germany's inflationary spiral and eroding investor confidence worldwide.
And he gets his feet under the desk in the Treasury Department. What happens? He is told, don't say anything about gold. Stumm. Don't talk about it. Why? Well, I can see two reasons why. Firstly, they are in denial about gold because they have been promoting the dollar as gold's substitute, if you like. It's a dollar standard around the world. And the second thing is a lot of that gold, I think, went out. It was leased and never came back. You open Fort Knox, I think someone rather cleverly said, you find a whole bunch of IOUs sitting there. We don't know whether this is really true because, of course, we can only surmise. But intellectually and practically, I think it's going to be extremely difficult for the mighty dollar to if you like, get away from its total collapse. So that's what we face. I mean, this is a very serious time. We are in a sort of, if you like, an intermediate stage where, the Fed is trying to put some liquidity back into the system because it sees the danger. It's been told the danger by its intelligence in the commercial banking network. That will give us a little bit of relief. It might even puff equities even higher. I don't know. But the only way you can get out of this, basically, is get the hell out of credit. It's really dangerous now. Get out of credit, which means getting into real money, which is metallic money with no counterparty, and it is final settlement for all credit, and that is gold. I think that's where we are. You could find that the authorities turn around and actually do something sensible, like secure the value of the dollar somehow. I mean, there may be some sort of fiddle they can do and all the rest of it. I mean, people have been talking about a reset for ages. It's not a reset. It's just to try and secure the value of the dollar. The only way that can be done ultimately is basically by going on to a gold standard. This slide, I think, could happen quite quickly. I mean, once the credit bubble bursts, I've got people who sort of, seem to have been very successful in terms of, reading cycles and things like that. And I think we're looking at March next year, ultimately. But I wouldn't be surprised if it happens before then. When that happens, then basically, I know this sounds a bit panicky. When that happens, basically, you should already be completely out of credit, because the collapse, I think, will be really quite rapid from that point. And they will obviously try and do what they can to stop it and all the rest of it, but it's just going to undermine the purchasing power of the dollar. So in terms of time, I don't think we're far away from the end of the fiat currency system. And the point about being close to the end of the fiat currency system is that we're close to it, fiat currencies not being there. Now, either they're replaced by something else like a new gold-backed currency or whatever, or they tie it to gold, and incidentally have to take the economic actions to ensure that it sticks. We're nowhere near that. Nowhere near that. I don't know. I just sort of feel that we are actually moving more rapidly than we think towards the end game of fiat currencies. Mm-hmm. It could be a year, could be 2 years, could be 3 years. I don't know. But just watch. I think the first indication you will get is when the credit bubble pops, you'll then know that the end of the fiat currency system is not going to be terribly far behind. Well, at the moment, it is a blip on the radar, but I think it's symptomatic, perhaps, of the background position, which is really what we're talking about. So I think you're going to see more of these problems. You may not. I don't know whether. I saw one estimate that the Fed's got to put about 150 billion into financial markets, which will do by QE. It's got to do that pretty quickly. If it does it pretty quickly, then you're not going to see too many of these problems in the short term. And hey ho, the markets will continue to rise. Wonderful. But, this is a very, very febrile time, Danny. It's very dangerous. Do you want to sort of ride this roller coaster until it sort of runs into the buffers at the end, or would you rather not play? I mean, that's the decision. That is a very difficult decision I think investors have. To my mind, it's actually quite simple. Just get the hell out of credit. If someone makes an equity, the last 10, 15% in equities, then good luck to them. You never get out at the top. You never, ever get out of the top.
Did we see a local top in gold and silver a couple of weeks ago?
Uh, well, I mean, obviously it had run extremely well, and you could argue that there were profits to be taken and all the rest of it. The thing that's fascinating, though, is that while traders would have done that perhaps in futures and perhaps also in Shanghai, you still had a backwardation between London and COMEX. Mm-hmm. And if you look at the volumes in the silver contract on COMEX, I mean, it's just gone to a crawl. They're not dealing, basically. So nothing has been resolved. You've still got the problems there.
The global financial system is facing an unprecedented period of risk. As liquidity strains intensify, the Fed is attempting to inject relief through quantitative easing. But does this really solve the problem or merely delay the inevitable? Record margin debt, speculative markets, and over-leveraged equities suggest the top of the cycle is imminent, while gold remains the ultimate refuge from counterparty risk. Once the credit bubble bursts, the collapse is expected to be rapid, undermining the purchasing power of the dollar and exposing the fragility of fiat currencies. Even temporary interventions may only puff up markets briefly. The first signs of this systemic shift will emerge when liquidity strains surface, revealing that moving out of credit and into tangible assets may be the only way to preserve wealth. If you found this information valuable, make sure to hit like and drop a comment below with your thoughts. Don't forget to subscribe and turn on notifications so you never miss the latest updates. Thanks for watching.